Ecora Resources is building a royalties portfolio with copper at its core. Now, the portfolio is experiencing significant organic growth in base metals exposure, with assets like Voisey's Bay Cobalt and Mantos Blancos copper ramping up production, while their coal royalty at Kestrel operates on variable timing cycles, naturally evolving their portfolio toward 85% base metals exposure, or composition rather, by 2030. As you can see, I've got CEO Marc Bishop Lafleche here with me to kind of contextualize this growth for us and tell us a lot more about the business. Marc, first of all, thank you for being here with us here in Toronto at our studio. Like I said, contextualize the portfolio growth for us and outline what kind of metals exposure you have beyond the copper and other metals I just mentioned.
Well, first of all, great to be here today. Thank you for having me. And it's been said that the best time to plant a tree is yesterday. And in that sense, we're very happy with how the portfolio looks today, based on the efforts we've put in over the past few years. We're sitting at a point in the market today where copper supply, as a result of operational disruption across a number of operations this year, is expected to be in deficit to supply this year and next year. We're looking at a uranium industry where you're expected to see very strong demand growth with, at this point anyways, a very challenging timeline to bring new projects into production to meet that growth. And on top of that, strong demand from finance vehicles who buy uranium and hold that uranium as inventory as a way to play the commodity. And in addition, in our cobalt exposure, we're seeing, number one, the DRC government imposing export limits on that commodity at levels that are below half actually, of what was produced last year. And on top of that, the U.S. government is now looking and evaluating the potential to store cobalt metal for its strategic stockpile. So the assets we have now, I think, benefit from very strong tailwinds in the market backdrop. And at the same time, we're seeing very strong volume growth and ramp up. And in many ways, this is the beginning of our portfolio. To the second part of your question, we saw quite strong cobalt and copper ramp up in the first half of this year, and that's expected to continue into next year. But beyond that, our portfolio is structured with approximately 50% of our asset base in copper. The next 30% is a mix of cobalt and nickel, with the balance being rare earths, vanadium, uranium, as I mentioned. So yeah, this portfolio in many ways seems to be really coming together in terms of its next wave of growth at the right time with really strong price tailwinds. It's exciting for Ecora.
Well, specifically in the first half of your year, your base metals portfolio contribution surged 81%. What's driving this operational momentum at your key projects, Voisey's Bay and the Mantos Blancos, and how sustainable is this growth trajectory?
Well, the first part has been at Voisey's Bay, really driven by a ramp up of the underground mining operation. So Voisey's Bay historically was an open pit mine, and the operations there, Vale Base Metals, have moved from the open pit to the underground. So what we've seen over the course of this year really started late 2024 when the underground expansion project was completed, and the focus then turned to ramping up production. And we saw volume growth, strong volume growth in Q4, which is carried forward into the first half of this year. And actually at Voisey's Bay, in the first 2 months of the third quarter, we received more cobalt than we received actually in the entirety of the first half of the year. So this ramp up is happening. The volume growth is expected to carry forward for the remainder of this year towards steady state production. And actually, if you look beyond that, there's certainly potential for throughput increases such that our cobalt entitlements would increase thereafter. So it's a very sustainable source of growth. And I think it's just the tip of what that asset can do in the future. Beyond that, Voisey and Mantos Blancos, we saw a very strong operational execution at the mine by the Capstone team, and that's expected to continue into the future. Beyond that, a lot of the growth in the short term, frankly, is just driven by assets that are ramping up to nameplate capacity, and as such, we expect more of what we saw in the first half of the year, which is volume growth, and as such, growth in our base metals and other critical minerals assets this year, next year, and beyond.
Marc, you've also got rare earths exposure through Fala Borwa, where Rainbow Rare Earths is advancing toward a definitive feasibility study. Now, talk to us about how significant the project could become for the overall portfolio.
We acquired this royalty last summer, and when we acquired it, it was on the thesis that rare earth supplies to the world of approximately 90% plus from China was not sustainable, and that in a geopolitically charged world that we live in, this commodity really had the potential, or the commodities as rare earth elements had the potential to be, to some degree, weaponized as a tool. And while I can't say this year we've seen full weaponization of rare earths, what we have seen is a restriction in the availability of rare earths to the world, and as a consequence, impacts across global supply chains and industries and areas where folks never really imagined rare earths would actually be involved. As an example, I think it's well understood that rare earths, in particular the NdPr permanent magnets, are required as an essential element in an electric engine and EVs. What was less expected was these same permanent magnets are required to produce combustion engines. And as a consequence, we've seen automakers stating that their production lines almost came to a stop earlier this year. So this project, Palabora, is really at the front end of the development curve. It's supported indirectly by the US government as a shareholder via a group called TechMet. TechMet has the right to part fund the construction. And this project really has the potential to come to market very quickly at a time where alternate sources of rare earths are an absolute necessity. We've also been really pleased with the cyclical performance and the entry point we've had at this royalty since then. It's not a core portion of our portfolio, but we do believe that this exposure really complements the other commodities we have in our mix.
Well, we actually had a rare earths producer, or they expect to produce in 2028 here in our studio yesterday. And I asked this question to them, and I want to ask it to you. How effective do you think Western governments have been so far in responding to essentially looking for other alternatives to heavy or rare earth products around the world?
Look, the challenge with rare earths in many ways is, number one, deposit quality of varying degrees, and number two, processing.
The cost, is that what you mean?
Well, precisely. The cost and the economics. China is a very low-cost producer, and thus to be competitive, that requires a higher price. We've seen 60 to 70% improvement in NdPr prices a year on year, or 12 months ago versus today. But still, that's still, for many projects, an incentive price which is quite close to the edge, or potentially not substantial enough to bring these projects to market. And actually, you saw the MP Materials offtake transaction with the US government at a floor price of 110 per kilogram, which, in their words, was to provide a price level that protected the project from non-market forces. One of the things that we really like about the Palabora project is that it's not actually a mine. This material is leftover residue, phosphogypsum, that was originally a byproduct of creating phosphate fertilizer. So what you have in this material is a grade equivalent to a hard rock deposit, but none of the costs of mining hard rock in terms of mining, crushing, material movements, overburden, stripping, none of that. So this project actually is exceptionally well positioned, defensively positioned vis-a-vis some of the lowest cost supplies out of China.
Okay. Well, if we can for a moment go and jump back into uranium, you've also got exposure to what NextGen describes as a potential generational discovery at Patterson Corridor East. How meaningful is your uranium exposure to the development timeline for PCE?
Yes, our wider uranium exposure includes some assets that for many will be household names. So we have a toll milling exposure to Cigar Lake and stand to benefit from the expansion beyond the current reserve life well into next decade potentially. Number two, we have a producing royalty exposure on a ISR, or in situ recovery mine, in Australia called 4 Mile. And longer term, the Patterson Corridor East exposure, which as far as drilling programs go, it's hard to describe what we've seen to date as anything other than, I think, geologically exceptional. This is a longer dated royalty, but this deposit, as it's delineated, and really has the potential to be a world class amongst the best royalties in the world. for uranium deposits. So got to play that out. NextGen has suggested that at this stage of the exploration program, the deposit is somewhat analogous to Arrow. And if you believe Arrow, call it 30 million pounds a year, pick your uranium price in the future, say $100 per pound. We have a 2% entitlement with the right for NextGen to buy back 1%. So assume 1% entitlement. That equates to something like 30 million a year, which is pretty spectacular as far as royalties go. So we're watching it very, very carefully. It's still early days, of course, right? The deposit has not yet been delineated with the resource. That's certainly something we'll be watching very carefully. And while it's not directly in our control, we certainly hope will be forthcoming as quickly as possible.
Well, Marc, let's look ahead to the second half of 2025. You've highlighted multiple catalysts, including heavy Kestrel production, weighing your second half of the year, plus other development milestones. Can you tell us what we should expect as key value drivers moving into the remainder of this year?
Well, starting with Kestrel. Kestrel is a royalty where mining operations can occur outside of a royalty area and inside of our royalty area as the mine plan advances. And thus what we have is some volatility. Earlier this year, Kestrel was operating outside of our royalty area. At the end of the second quarter, mining came back into a royalty area. So we're very confident in having a much stronger second half at Kestrel. And actually, for any of your audience who are visual and would like to understand this in more detail, in our corporate presentation, there's a picture of the map, the mine plan, our royalty area, and I think that really helps people understand how this is possible and how it affects the company. I think the second thing we're really excited about in the second half of the year, and I've touched on it already, and this is just the continued ramp up of assets that are already in production. And here we're quite excited about it simply because what we're talking about are cash flows over mines that have mine lives that are measured in decades. And that compares really favorably to historically cash flows coming in from Kestrel, where the mine life is measured in years, actually. And then third, in the second half of this year, we're expecting to see continued strong deleveraging following the acquisition of the $50 million producing copper stream that we acquired that I mentioned earlier in response to another question.
Yep.
Here, we're actually ahead of our deleveraging schedule that we anticipated at the time of the transaction. And subject to commodity prices and production that are guided and expected, the consensus case actually is that we finish the year roughly in line with where we started from a net debt perspective, which would be a phenomenal outcome, having spent $50 million on this royalty. And then the fourth point, in the short term, we expect quite a few key de-risking events in relation to a number of royalties, which are expected to either increase production or start producing in between, in the next 3 to 5 years. So I think when you look to the future, the next 6 months in many ways deliver revenue growth that's repeatable, but beyond that, further confidence on further sources of revenue that again run many, many decades, which it's an incredible improvement considering that this company historically was really tied to one royalty. And as I said, the royalty life was sort of 10 years, now down to materially 3 or 4 or 5.
Well, great time to be here to speak with you during this time to raise awareness for the story. Thank you, Marc, for being here.
Pleasure. Thanks for having me.
All of us can go to CEO.CA, like I always say, search the ticker symbol and find out what investors are saying at any time as you track real-time trading data right beside the message board. Thanks for watching.